The IMF just raised its growth forecasts for China, and that matters well beyond China's borders. The International Monetary Fund has upgraded its GDP projections for China through 2027. GDP, gross domestic product, is the broadest measure of what an economy produces. When the IMF revises that number upward, it signals greater confidence that China can sustain real expansion over the next several years. The IMF monitors economic conditions in nearly every country on Earth and advises governments on policy, so its assessments carry genuine weight in markets and in government ministries alike. The timing is notable. The global economy is navigating uneven recovery, trade tensions, and persistent uncertainty about where growth is headed. Against that backdrop, a more optimistic read on China is meaningful, because China sits at the center of world trade, commodity demand, and global supply chains. When China grows faster, that tends to ripple outward. Exporters across Asia and Europe benefit. Demand picks up for raw materials, oil, copper, industrial metals. Commodity-linked currencies in countries that supply those materials tend to firm, and broader concerns about a global slowdown ease, at least at the margin, because a weakening China has historically been a drag on growth everywhere else. For investors, a stronger China outlook can lift sentiment toward emerging market assets more broadly, not just Chinese stocks and bonds, but assets tied to economies that trade heavily with China. That said, the revision does not erase the real headwinds China still faces. The property sector remains under pressure, consumer spending has been cautious, and friction with major trading partners over tariffs and technology has not gone away. The IMF typically flags those risks alongside any improved baseline, and the forecasts will only hold their credibility if incoming economic data confirms the trajectory. There is also a longer-term angle here for inflation and interest rates. A faster-growing China tends to push up global demand for energy and industrial goods. That can feed through to prices worldwide. Central banks, including the US Federal Reserve and the European Central Bank, track Chinese demand trends as one input when setting interest rate policy. A sustained upturn in Chinese activity could complicate the path toward lower rates in other economies if it pushes commodity prices higher. The practical takeaway: watch China's monthly economic data, industrial output, retail sales, and trade figures as they arrive over the coming months. Those numbers will tell you whether the IMF's upgraded forecast is tracking reality or running ahead of it. The projection sets the expectation. The data either confirms it or it doesn't. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.